Why Wall Street is quietly betting $2.1 trillion against America's homeowners. $2.1 trillion, not a forecast, not a theory, a documented position. The largest financial institutions on earth have placed instruments that only profit when American homeowners fail, not if they fail. When? They're not gambling, they're reading something most people can't see yet. And if history has taught us anything, it's that Wall Street doesn't position this large, this quiet, this coordinated, unless the math has already been done. So what do they know? And more importantly, what happens next? Welcome to your John A.G. Now before we go any further, let me ask you something the way I'd ask my own father. You've made it this far in life by paying attention to what matters, haven't you? Well, this matters. So do me a favor, hit that subscribe button. Not because I'm asking for a favor, but because what comes next, you'll want to remember where you heard it first. And drop a comment below, tell me where you're watching this from. New York? London? Mumbai? Texas? I want to know who's paying attention because the people who see this early are the ones who move differently. All right, let's begin. In the summer of 2024, something unusual began appearing in the footnotes of quarterly reports from America's largest financial institutions. Not headlines, not press releases, footnotes, line items buried deep in disclosure documents that most investors never read. But for those who did read them, the numbers told a story that contradicted everything being said in public about the strength of the American housing market. Goldman Sachs had increased its position in credit default swaps tied to residential mortgage-backed securities by 340% in 6 months. JP Morgan Chase had quietly accumulated $127 billion in derivative contracts that appreciated when mortgage credit quality deteriorated. Blackstone, Citadel, Bridgewater, and a dozen other institutional giants were building positions in instruments with names most Americans had never heard of. CMBX indices, ABX-HE contracts, synthetic CDOs tied to subprime and Alt-A mortgage pools. By January 2025, the total notional value of these positions had reached $2.1 trillion. To put that number in perspective, that is larger than the entire economy of Canada. It is 3 times the size of the bailout package deployed during the 2008 financial crisis. It represents coordinated capital allocation on a scale that happens perhaps twice in a generation. And every single dollar of it profits when American homeowners default. Now here is what makes this different from gambling. A gambler walks into a casino hoping luck breaks his way. These institutions are not hoping, they are calculating. They employ teams of quantitative analysts who model cash flows, payment schedules, delinquency probabilities, and regional employment fragility with precision that approaches certainty. They know which loans were written at the peak. They know which borrowers stretch to qualify. They know when adjustable rate mortgages reset. They know when promotional periods end and real rates begin. They track credit card balances, auto loan delinquencies, and savings rate deterioration across every zip code in America. This is not speculation. This is informed positioning. And the critical question is not whether they might be wrong. The critical question is, what do they see that the general public does not? The mechanics of these instruments are straightforward. A credit default swap, for example, functions like insurance. One party pays a premium. In exchange, they receive payment if a specified loan or pool of loans defaults. The worse the loan performs, the more the contract pays. Similarly, shorting mortgage-backed securities means borrowing those securities, selling them at current prices, and profiting when prices fall as defaults rise. The instruments themselves are neither illegal nor unethical. They exist to allow institutions to hedge risk and express economic views. But scale matters, direction matters, timing matters. When $2.1 trillion moves in one direction, it is not hedging. It is positioning for an event. The institutions holding these positions are not fringe players. They manage the retirement funds of teachers, police officers, and firefighters. They underwrite corporate debt. They backstop municipal bonds. These are the entities that middle-class Americans depend on for financial stability, and they are betting against middle-class Americans' ability to keep their homes. That contradiction is not lost on those paying attention. But for most people, this entire ecosystem remains invisible. They see mortgage rates, they see home prices, they see headlines about inventory shortages and bidding wars. What they do not see is the derivatives market, the credit market, the institutional flow of capital that moves months before Main Street feels the impact. By the time the general public recognizes a shift, the largest players have already positioned. By the time foreclosure rates make national news, the profits have already been extracted. History shows this pattern repeating with remarkable consistency. In 1928, institutional money quietly exited equity markets, while retail investors poured in. In 2006, hedge funds built massive short positions in subprime mortgage bonds, while home builders reported record sales. The crowd sees the present, institutions see the future, or at least the probabilities. And right now, the probabilities have $2.1 trillion worth of conviction behind them. So the question is not whether Wall Street is betting against homeowners. The evidence is documented, public, and verifiable. The question is why? What structural vulnerabilities have they identified? What timeline are they operating on? And what does history teach about what happens next when this much capital aligns in one direction? The answer lies in a pattern, a 4-stage cycle that has preceded every major housing collapse in modern economic history. And America is deep into stage 3. There's a moment in every financial collapse when someone quietly says, "We've seen this before." Not loudly, not in public forums or televised debates, but in private conference rooms and encrypted emails, in the kind of conversations that never make it to CNBC. Because the truth is, housing market collapses do not arrive without warning. They follow a script, a 4-act structure so consistent across time and geography that it might as well be encoded in human nature itself. The first time this pattern was documented in detail was after the Panic of 1873. A Swedish economist named Knut Wicksell spent 7 years analyzing what had happened to property markets across Europe and America. What he found was not chaos, it was sequence, a repeating rhythm that played out in London, in New York, in Vienna, in Stockholm. Credit expanded, speculation normalized, mathematics broke, defaults cascaded, same order, every time. Since then, the pattern has repeated in the Florida land boom of the 1920s, the savings and loan crisis of the 1980s, the Japanese asset bubble of the 1990s, the American subprime disaster of 2008, and the Chinese property sector implosion of 2021. Different countries, different currencies, different regulatory environments, same pattern. So when analysts today look at $2.1 trillion in institutional positioning against American homeowners, they are not looking at a random event. They are looking at stage 3 of a 4-stage cycle. And once stage 3 is visible, stage 4 becomes a matter of when, not if. Let's walk through it. Stage 1 is called credit expansion. It begins quietly. Interest rates drop. Lending standards soften. Banks compete for market share. Loan officers are incentivized to approve rather than deny. Debt-to-income ratios stretch from 28% to 35%, then to 43%, then higher. Products that did not exist 5 years earlier become standard offerings. Adjustable rate mortgages, interest-only loans, stated income documentation. This is not criminal. It is competitive pressure meeting human optimism. Every lender believes they are being prudent. Every borrower believes they can manage the payment. And for a while, the math works, because rising home values provide equity cushions that make refinancing easy. In America, this phase ran from 2020 through early 2023. Mortgage rates fell below 3%. Lending volume exploded. Borrowers who could not have qualified in 2019 suddenly held keys to $400,000 properties. It felt like access. It felt like opportunity. And in real time, no one called it dangerous. Stage 2 is called speculation normalization. This is when the market stops being about shelter and becomes about wealth building. Investors enter. House flippers multiply. Television shows glorify property portfolios. Dinner conversations shift from jobs and family to equity and appreciation rates. The psychology changes. Home ownership transitions from a 30-year commitment to a 3-year trade. People buy not because they need the house, but because they need the asset. First-time buyers compete with seasoned investors who can close in cash. Bidding wars become routine. Appraisals become obstacles to be managed rather than safeguards to be respected. By 2022, investor purchases accounted for 28% of all home transactions in the United States. In cities like Phoenix, Austin, and Charlotte, that number exceeded 35%. Entire subdivisions were purchased sight unseen by LLCs and investment syndicates. This is the stage where normal people begin to feel priced out, where the dream of ownership begins slipping away for the next generation. But prices keep rising, so those who are in feel wealthy. Those who are out feel desperate to get in before it is too late. Stage 3 is called mathematical unsustainability. This is where the numbers stop working, even if no one wants to admit it yet. Median home prices relative to median incomes reach levels that cannot be serviced by average wages. Payment shock timelines become visible to anyone running the calculations. Adjustable rate mortgages approach their reset dates. Variable rate loans adjust upward as central banks raise rates to combat inflation. Here is what that looks like in practical terms. A borrower who locked in a mortgage at 2.9% in 2021 now faces a market rate of 7.2% if they try to refinance. That transforms a $2,400 monthly payment into a $4,100 monthly payment on the same loan balance. For 82% of American homeowners, refinancing now means a payment increase they cannot afford. Simultaneously, credit card debt crosses $1.1 trillion. Auto loan delinquencies hit levels not seen since 2009. Savings rates collapse. The financial margin that allowed households to absorb unexpected expenses evaporates. Affordability does not just decline, it breaks. And when affordability breaks, the market does not freeze, it reverses. This is where America sits today. Stage 3, visible to anyone with access to credit data, employment figures, and debt service ratios, invisible to those watching home prices alone. Stage 4 is called default cascade. This is not a prediction, it is a description of what happens when stage 3 reaches its mathematical conclusion. The first wave of defaults creates inventory. Inventory creates pricing pressure. Pricing pressure exposes over-leveraged positions. Forced sales accelerate declines. Declines trigger margin calls and covenant breaches. Credit availability contracts. Recovery becomes impossible because the leverage that fueled the rise is now amplifying the fall. In 1933, 1 in 4 American mortgages was in default. In 2010, foreclosure rates peaked at 11%. In Spain, home prices fell 35% over 6 years. In Ireland, the decline was 50%. These were not acts of nature. They were the fourth stage of a pattern that announced itself years in advance to anyone who knew how to read it. And that is why $2.1 trillion is positioned the way it is. Because Wall Street is not betting on a possibility. They are reading a pattern that has never failed. There's a difference between knowing a storm is coming and knowing exactly where it will make landfall. Wall Street knows both. Because while the general public debates whether housing will crash or hold, the institutions positioning $2.1 trillion against American homeowners are not debating anything. They are measuring. They are tracking specific data points that most people have never heard of, but that predict mortgage stress with startling accuracy. And right now, every single one of those indicators is flashing red. Not metaphorically, not in some abstract economic sense. Literally flashing red on the dashboards of risk management systems at every major financial institution in the world. Let's start with something called the mortgage debt service ratio. It measures the percentage of household income required to service mortgage debt. For the past 40 years, the healthy range has been between 4% and 5.5%. When it climbs above 6%, mortgage stress becomes systemic. As of December 2024, the American mortgage debt service ratio sits at 6.8%. That is the highest reading since 1982. The only other time it reached this level was in 2007, 6 months before the subprime collapse began. But here's what makes the current situation more dangerous. In 2007, homeowners could refinance out of trouble because home values were still rising. They cannot refinance. They cannot sell without losing equity. And they cannot afford the payment if anything in their financial life breaks. That is not a vulnerability. That is a trap. Now, add the next layer. Between 2025 and 2027, $1.3 trillion in adjustable rate mortgages are scheduled to reset. Most of these loans were originated in 2020 and 2021 when borrowers were told that rates would stay low for years. They were given promotional periods, teaser rates, payment structures designed to be affordable in the short term. Those periods are ending. A borrower who qualified for a $3,200 monthly payment at 3.1% will see that payment jump to $5,400 when the loan resets to current market rates. For a household earning $96,000 annually, that transforms an already tight budget into an impossible equation. And this is not speculation. The reset schedule is contractual. The dates are fixed. The rate adjustments are formula-driven. Every single one of these mortgages is documented, tracked, and visible to anyone with access to loan-level data. Wall Street has that access. Homeowners do not. Then there's the shadow inventory problem. This is the housing supply that does not show up in official statistics because it has not been listed for sale yet. It includes properties held by investors who are underwater, homes in pre-foreclosure that banks have not yet seized, and distressed assets being held off-market to avoid triggering comparable sales that would lower valuations in the neighborhood. Industry estimates put shadow inventory at 1.8 million units nationwide. For context, normal inventory in a balanced market is around 2.2 million units. That means there is nearly as much hidden supply as visible supply, and the moment pricing pressure forces that inventory into the market, the flood begins. But the most telling indicator is not in the housing market at all. It is in consumer credit behavior. Auto loan delinquencies have reached 8.2%, a level not seen since the aftermath of the 2008 crisis. Credit card balances have crossed $1.1 trillion with average interest rates above 21%. Personal savings rates have collapsed from 9.4% in 2021 to 3.1% today. These are not isolated statistics. They are signs of income insufficiency. And income insufficiency does not stay contained in the auto loan market or the credit card market. It spreads to the mortgage market because the same household is servicing all three debts. When someone misses a car payment, they are 6 months away from missing a mortgage payment. When credit card balances surge, it means households are borrowing to cover ordinary expenses. When savings disappear, it means there is no cushion left, and Wall Street tracks all of it in real time. But perhaps the most damning evidence comes not from data, but from behavior. Specifically, the behavior of the people who build and finance houses for a living. In the third quarter of 2024, the 5 largest home builders in America reduced their land acquisition by 43%. That means they stopped buying land for future development. Companies like Lennar, D.R. Horton, and Pult Group, which spent decades expanding inventory, suddenly reversed course. Why? Because they read the same data Wall Street reads, and they see the same timeline. At the same time, regional banks began quietly selling their mortgage portfolios at a discount. Wells Fargo sold $1.8 billion in residential mortgages at 91 cents on the dollar. Bank of America offloaded $2.3 billion at similar losses. They are not selling because they need liquidity. They are selling because they do not want the exposure when defaults accelerate. Insurance companies are pulling back too. Mortgage insurance underwriters have tightened standards by 60% in the past 18 months. They are raising premiums, increasing down payment requirements, and refusing coverage on loans they would have written without hesitation 3 years ago. These are not reactive moves, these are preemptive exits. And then there is geography. Because housing collapses do not happen evenly. They concentrate in the places where speculation ran hottest, where investor ownership is highest, where employment bases are fragile. Phoenix, Austin, Boise, Charlotte, Tampa. These metros saw price appreciation of 40% to 60% between 2020 and 2023. They also saw investor purchases exceed 30% of all transactions. And they have employment bases concentrated in sectors like technology, finance, and real estate, which contract aggressively during downturns. When the adjustment begins, it will not begin everywhere at once. It will begin in these cities, and the comps generated by distressed sales in these markets will ripple outward into secondary and tertiary markets, pulling valuations down across entire regions. Wall Street knows which zip codes crack first. They have mapped the failure sequence with the same precision that seismologists map fault lines. So when people ask whether a housing crash is possible, they are asking the wrong question. The right question is whether the mathematical structure of the current market can hold under the weight of rising payments, falling liquidity, and contractual reset schedules. And the institutions with $2.1 trillion on the line have already answered that question. Knowledge without action is just expensive entertainment. So here's the part that matters. Not what Wall Street knows, not what the data shows, but what you do with that information starting today. Because the institutions positioning $2.1 trillion against American homeowners are not panicking. They're not liquidating portfolios in fear. They are methodically building positions that profit regardless of which direction the crisis unfolds. They have scenarios, they have timelines, they have exit strategies for every possible outcome. And the difference between those who survive a market adjustment and those who become its casualties is not intelligence, it is preparation. So let's build a framework. First, understand your exposure. Most people measure their housing risk by asking whether they can afford their current mortgage payment. That is the wrong question. The right question is whether you can afford that payment if 3 other things go wrong simultaneously. If your income drops by 20% due to layoff or reduced hours, can you still make the payment? If your variable expenses increase by 30% due to inflation or medical costs, does the budget still work? If your home value declines by 25% and you need to sell, can you cover the difference between sale price and mortgage balance? Run those scenarios right now, not hypothetically. Actually calculate them, because if the answer to any of those questions is no, you are not in a secure position. You are in a leveraged position that only works if nothing breaks. The institutions betting against homeowners are not betting that everyone will fail. They are betting that the percentage of people in leveraged positions is high enough that when external pressure arrives, the failure rate will be profitable. So start by reducing leverage, increase cash reserves, build a minimum 6-month emergency fund if you are a W-2 employee, 12 months if you are self-employed or commission-based. This is not conservative advice. This is survival architecture. Second, understand the difference between equity and liquidity. Home equity is not wealth. It is trapped value. You cannot spend equity unless you sell the house or borrow against it, and both of those options disappear when markets decline. If your net worth is concentrated in home equity, you're not wealthy. You are illiquid. Wealthy people hold diversified assets, cash, stocks, bonds, commodities, businesses. Real estate is one piece, not the entire puzzle. And during market adjustments, liquidity is the only thing that matters, because liquidity is what allows you to act when others are forced to react. If you are sitting on significant home equity in a market that saw explosive appreciation between 2020 and 2023, consider whether it makes sense to extract some of that equity now while credit is still available and redeploy it into liquid assets. Not to spend, to position. Because the people who built wealth during the 2008 collapse were not the ones trying to hold on to overvalued houses. They were the ones who had cash when everyone else needed it. Third, monitor leading indicators, not lagging headlines. By the time foreclosure rates make national news, the opportunity to adjust has already passed. Leading indicators give you a 6 to 12-month warning window. Here's what to watch. Auto loan delinquencies in your region. When they spike above 7%, mortgage stress follows within 9 months. Credit card charge-off rates at major banks. When they exceed 4%, it signals household income insufficiency is spreading. Regional employment numbers, not national averages. A metro can collapse while the national economy reports growth. Building permits and housing starts in your city. When builders stop breaking ground, they see something. Days on market for comparable homes in your neighborhood. When inventory sits longer than 45 days, pricing pressure is building. Mortgage application volume. When it drops below historical norms, demand is evaporating. These data points are public. They are updated monthly. And they give you actionable intelligence that most people will not see until it is explained to them on television, which will be too late. Fourth, recognize that downturns create asymmetric opportunities. This is not a message of fear. It is a message of preparation. Because while the unprepared lose equity, income, and stability during market adjustments, the prepared acquire assets at generational discounts. In 2010, investors who had maintained liquidity purchased homes at 40% to 60% below peak prices. Those properties are now worth 3 times what they paid. In 2020, businesses that survived the pandemic with cash reserves acquired competitors in real estate for fractions of pre-crisis valuations. The pattern is consistent. Market dislocations transfer wealth from the leverage to the liquid, from the reactive to the strategic, from those who hoped nothing would go wrong to those who prepared for when it did. So if you are an entrepreneur, a business owner, or someone building toward financial independence, the question is not whether to be afraid of what is coming. The question is whether you will be positioned to capitalize on it. That means holding cash now, even though it feels inefficient. It means avoiding new debt, even though credit is available. It means resisting the urge to stretch for a bigger house, a nicer car, a more expensive lifestyle, because the cost of that stretch is the opportunity you will miss when assets go on sale. Fifth, understand the timeline. No one can predict the exact month the market turns, but the sequence is predictable. Delinquencies rise first, then inventory increases, then price reductions begin appearing, then comparable sales start pulling valuations down, then forced liquidations accelerate the decline. That sequence takes 12 to 18 months to fully play out once it begins. Right now, we are in the delinquency phase. Auto loans and credit cards are showing stress. Mortgage delinquencies are rising, but not yet critical. That gives you a window, not to panic, not to sell everything in fear, but to audit your position, reduce vulnerability, and build optionality so that when the adjustment accelerates, you're not scrambling, you are choosing. Finally, reject the narratives designed to keep you passive. You will hear that housing never goes down. You will hear that this time is different. You will hear that government intervention will prevent any serious decline. You heard all of that in 2006, too. The institutions with $2.1 trillion positioned against homeowners are not listening to those narratives. They are reading balance sheets, tracking payment data, and modeling failure rates. You should do the same. Because preparation is not pessimism. Preparation is respect for patterns that have repeated across centuries. And the people who respect those patterns are the ones who navigate them successfully. Wall Street is not betting against you personally. They are betting on a mathematical outcome driven by leverage, payment shocks, and affordability collapse. Your job is to make sure you are not part of that math. Position accordingly.